Hi, everyone. Welcome to the panel about digital securities 2020 and beyond. Today, we have an amazing set of expertise and speakers who join us today. Hello, everybody. We have with us Kathy Yoon, Special Counsel at Kadden Machen. We have Arnaud Salomon, CEO of Montpellier, Joel Teltner, Senior Partner at Sullivan, and Matthew Unger, CEO of iComply, who are behind this panel. And thanks to them, we are here today. Thank you, everyone, for joining us today. First of all, I would like you to tell a couple of words about yourself and your expertise about the digital securities, and then we'll jump right into the questions. Kathy, would you like to start?
Sure. Thanks for having me, and I'm very happy to be here. I'm Kathy Yoon. I'm special counsel at the law firm of Katten Muchin Roseman, where I co-head up our fintech and blockchain practice. Since joining Katten last year, I've represent a number of clients from blockchain video games to startups in the space to incumbent traditional financial services companies. And prior to joining Katten, I was general counsel of Genesis Block, a blockchain consulting firm and its affiliated broker-dealer, where we focused on digital securities. So that's me in a nutshell.
Pleasure to have you here. Arnaud, can you tell us a couple of words about yourself?
Yeah, sure. So I'm Arnaud Salomon. I'm the CEO and founder of Montpellier. Originally, I'm a quite early Bitcoiner, advocate of Bitcoin since quite some time. What we are working on and what animates our company today is mostly digital securities, how to incorporate securities into tokens in a compliant way without having to deal with new laws or new frameworks. So most of our work today is mostly towards that with the Swiss regulator in Switzerland to actually show that we can comply by adding rule engines to tokens to the existing regulatory framework, and that we can bring pretty much the entire balance sheet of a bank onto the blockchain in real time, yeah, and yet remaining compliant. So this is basically the goal of what we do today, and we have had quite some success on that with different clients, including ourselves first. We were the first company in Switzerland to manage to incorporate legally a share of a company into a token and to make it one thing. Yeah, so like the token holder is a shareholder, and that sounds something easy, but it was not at the time, to be honest. Really, it's really about making it recognized publicly that the token holder is a shareholder, and not only by a private contractual agreement between the issuer and the token holder. So that is big steps actually, and things are moving quite fast in Switzerland. And more than happy to answer questions if needed.
Thank you. Joel?
Hi there, I'm Joel Teltner. I head the FinTech and Blockchain practice for Sullivan Worcester, a global law firm. I'm based in our New York office. Back in 2014, I started working with the company Overstock that decided they wanted to issue a security on a blockchain. And at that time, nobody had even thought about doing anything like that. And that started me on a 2-year road where we worked with the SEC and FINRA over a 24-month period to try to figure out how you go about issuing and trading the security on a blockchain. We had to look at all the existing security laws, regulations in the US and figure out how to fit them into this new digital world, figure out where the regulations worked, where they didn't work, and come up with a way to actually issue and trade that security on a blockchain. And that particular transaction went to market in the fall of 2016, and I've been working in this space ever since, working with issuers of digital assets, working with trading platforms, exchange, working with folks all over the world and trying to figure out how to move this space forward in a rational and compliant basis. And I have a question for you, because I know the title of the program is 2020 and Beyond. Can we just skip 2020 and just talk about the beyond?
Like, since we're like 6 months into 2020, I think this is reasonable. So why not?
Just forget 2020 completely.
Yeah, fair enough. Definitely. Thank you, Joel. Matthew, please tell us a couple of words about yourself. I think your sound is a little bit delayed. If it's not on.
Yeah, so my name is Matthew Unger. I'm the founder and CEO of iComply, iComply Investor Services. We're a Canadian-based RegTech company.
Try once again. I think now it should be fine because there was a little.
Are you guys able to hear me now?
Yes, now it's perfect.
Okay, perfect. If need be, I can always reset. My computer seems a little slow this morning. So my name is Matthew Unger. I'm the founder CEO of iComply. We're a Vancouver, Canada-based RegTech company focused on really bridging some of the gaps between the finance world and technology from a regulatory perspective. So how do we provide regulatory rule sets for different markets, whether that's related to how you manage data, privacy, KYC, AML, or even things like security token transactions. We started in this space in 2017, which many players really, I think, started getting off the ground around that time. Our focus originally was actually very much in the token issuance space. So whether utility tokens, non-fungible tokens, securities, there's often still compliance, whether it's related to securities regulation or whether it's related to goods and services. There's usually rules around how you serve your customers or shareholders or stakeholders. And so we wanted to provide some tools for the industry, and that's really where we are with iComply today. And so I would say a big part of our focus now, in the state of 2020 where it is and the market where it is really helping to connect and bring together some of the different players that we work with in different markets so that we can start seeing some cross-border collaboration. Players like Mount Pelerin and some of the other players in the space are doing amazing work in each of their markets. And, I think everybody knows Joel's name in the industry and the work that Overstock accomplished. But, it's really the promise of fintech and, especially in the area of digital securities, is to really make things a lot easier when you're talking about cross-border transactions, and getting some of that stuff right is a big part of the puzzle, and it requires a lot of collaboration.
Definitely. Thank you, Matthew. And to start our questions today, if we start from the very beginning, what is actually digital security? Because there are multiple ways how people in the industry and outside industry especially understand this topic. So what's your take on this? What actually are we talking about here? Arnaud, I would like to ask this question to you first, because you mentioned the way how you were able to uniquely merge this blockchain and legally in Switzerland and your jurisdiction. So maybe you can take this one first.
Yeah. So actually today, anyway, most of the securities are already digital, right? The idea of having an underlying ledger that is open and usable by anyone is actually very new. And what we actually did in Switzerland was to show to the regulator that actually the token is not a new asset. Yeah? The token is just a technological vehicle that you can program to comply with the existing regulatory framework, and therefore there is no need for new rules for that. Yeah, and so it's just a technological vehicle. You can incorporate pretty much anything you want into it. What really matters is the underlying that you are incorporating into. If the underlying, in Europe we have the so-called MiFID rules, meaning that you need to make sure that when you distribute it to people, you need to make sure that they have the correct risk profile. Some people are risk averse, risk taker, some people are financial savvy, some are absolutely not. And depending on the complexity of the underlying product that you incorporate into this token, you might fall under those rules, and you might need to be sure that only people within a certain framework of risk appetites can actually receive and own such tokens. So this is the type of things that's by explaining to the regulator that actually it's a very different animal than Bitcoin and cryptos in general. Yeah, it makes actually things like the regulator is seeing it not as a threat anymore, but as an opportunity for the financial place of Switzerland. So what we call here digital securities is in the end traditional securities that you incorporate into a technological vehicle.
Joel, from the legal perspective, what's your take on digital securities?
So first, I think one of the things that Arno said, which is extremely important, is that most securities are already in digital form. I mean, it's been a long time since people started, trading pieces of stock on paper. So we're talking about a different way of transacting digitally using a distributed ledger blockchain to both trade and record the ownership of the security. But I do want to answer, and I apologize, but I want to do it from a slightly US perspective, because when we talk about digital equity or digital securities in this space, at least from the US perspective, there are two different camps or two different worlds that people get mixed up. One is when we were going through the ICO craze and people started to issue tokens, all of a sudden, the SEC was saying these are all securities. What they were saying is that because of the way the US defines security very broadly, they fell within this narrow category called an investment contract. And I don't need to go into all the reasons, as to what is or is not an investment contract, but because a lot of the tokens were considered to be an investment contract by the SEC, they were therefore security. However, we're not talking about an equity security. These weren't securities that showed up on a cap table. So you weren't a shareholder. It just meant that from a regulatory standpoint, because you potentially had the right to gain profit, or those tokens could appreciate in value, the SEC was treating them as a type of security. What we're really, I think, talking about now, in what Arno was talking about, was actually taking equity, what appears on the cap table of a company, and saying we can issue and trade that equity in a digitized form, or an equity token, an equity security, and use blockchain technology to facilitate how we record the ownership, how we trade that digital security, potentially eliminating a number of intermediaries that we have had to use in the past in order to clear and settle securities, and create a better methodology and a more efficient methodology of getting securities into the market. And so that's where, I think where we're really going, and what's really interesting is looking at the world of true equity securities and how we digitize them and create these equity tokens that creates a new way to issue and trade.
Thank you. Before we ask Kathy and Matthew, we have a question from the audience, which goes, is there a difference between a digital security and a digital asset? Kathy, would you like to take this one?
Yeah, I mean, I think, the one thing about this space is that we've become a little bit fast and loose with terms and how we categorize things and how we talk about things. And so I think, to kind of go through the lexicon and kind of break it down, it could be its own subject on its own. So I'm not going to really go there. But, if let's just take, for example, I'm just going to follow on Joel and take it from the US perspective, for example, the SEC, they see a difference between a digital security and a digital asset security. Right. Mm-hmm. So in one instance, the digital asset itself is the security. And in another instance, it is representing an underlying asset. And so instead of kind of going into, so there are nuances and there are differences. It will depend on who you are talking to, on what those differences are. And, if anything, I would love for there to be some sort of concerted and consolidated effort to find a way to harmonize these terms. But there are nuances. And I think people, when they hear these terms, instead of just accepting them or assuming that you know what it is, I think just ask the further question, what exactly are you talking about here?
But the problem is, if we harmonize all these terms, there's going to be all these blockchain experts that will be out of ICO advisory roles. So,
well, they should already be out of the ICO advisory role.
And I know, just add one thing quickly to what Kathy said, which is, she's absolutely right. A digital asset is often, we can take any asset and create a digital title that represents an ownership interest in that asset, but it doesn't necessarily make it a security. And so, as just an example, we can take a piece of art and create an ownership interest in that art digitally, and all of a sudden that becomes a digital asset that people can potentially trade. It doesn't mean it's a security, but it does mean that it's a way to represent that you have an ownership interest in some famous painting.
Yeah.
And also on this example that actually in Switzerland, if you actually tokenize art, let's say a Picasso, as long as it is just ownership, it's just an asset at the end of the day. But if you actually look at it from the perspective of having yield on top of it, yeah, because the guy that is managing the Picasso is actually renting it to different museums, galleries, etc., therefore generating yields for the owners, then it becomes actually a securities, you know. At the end of the day, if I write on a piece of paper that I will share with you 20% of my future revenue, that's already a security. So security is very good, but as soon as you have an exchange of future cash flow, that's pretty much for sure security.
Yeah.
Well, I think it go right back down to going back to the U.S. example, right back down to, you know, the orange trees versus the, you know, the whole tests that, you know, happened with, as an example, with Howie or different things like that, where, you know, it's now you're getting into, hey, I own this plot of land versus a whole bunch of people own this plot of land together or are generating profits from it. And there's definitely some obfuscation with the different terms: digital asset, digital security, virtual assets, etc. I know with some of our work with players like in the US, SEC or FinCEN or FINMA in Switzerland, different players like that, there is a move towards some homogenization of terms. So virtual assets, you know, FATF kind of decided, and you know, this is what we're gonna call these things virtual assets. When I think of something like a digital asset, which is different than a digital asset security, but I would, you know, in layman's terms, you know, say something like Bitcoin is a digital asset, right? It's or if I'm in a video game and you know, World of Warcraft, or I apologize for gamers, I'm not a gamer, but you know, as an example, I have a sword or an avatar or something else. It's fully digital, right? There's nothing in the real world that exists with this. It is a digital asset. A CryptoKitty is a digital asset. But if I were to create let's say a smart contract that would hold a 223, that would hold a bunch of CryptoKitties and breed them and share the profits, now I have a digital asset security. That is now, you know, those CryptoKitties aren't securities. Those oranges aren't securities. That Picasso that Arnaud was talking about is not the security. But because we've created this scheme over top of it, we've created now the next layer, the digital asset security. I'd be curious to hear, you know, from different players, you know, we have different parts of the world here. You know, when you guys are seeing the change, you know, there's been I think everybody here has been in this for a couple of years now. We've seen, you know, Arnaud, you mentioned that, you know, things are moving quickly, you know, fairly quickly in Switzerland now, but we've also seen that Switzerland has wet signature requirements for a lot of securities transactions still, which can create complications for smart contracts. You know, what do you guys see in the different markets as some of the near-term challenges that maybe over the next year that we may see some change from the regulator that'll change the landscape or opportunity in the market?
Yeah, so I mean, from my perspective, and this is a very personal opinion, there is a missing link today in this industry, and this is like a proper stable coin that people recognize in different currencies. The main issue here is that every time you want to tokenize, let's say, an apartment in France, and therefore people are starting to exchange values in this property via DEXs, etc., it's always quoted against Ether. And therefore, against Ether, it makes it very complex for people to represent what it is really. I mean, we do, for example, a lot of demonstration within banks, within different financial institutions, payment institutions, on how this can be game changer, you know, even securities house, etc. Even the concept of, you know, maybe, you know, this centralized place for trust, which is called exchange, bourse in France. In French, it's actually something that maybe not really needed, because at the end of the day, it's just an order book and a matching engine. And an order book is a very simple concept. It could actually be part of the network layer itself. And basically anyone like TCP/IP would have access to it from their own wallet, yeah? And you would have a shared order book that everybody could trade upon. It would be owned by no one. It would have its own life, self-living. But in order to actually get into there, and this is something that we have proposed to FINMA actually, to get into this direction, we need to actually be able to demonstrate that there is a credible stablecoin that is actually not something that is subject to maybe changes in the future, or that is running out of like some dodgy jurisdiction, or that is this and that, yeah? And now we have come up in Switzerland with different players that want to actually pop up with their own stablecoin. And this is also the threat, because now each and every player wants, for maybe for ego and for vanity, whatever, they actually create their own stablecoins, and instead of them, going together and federate or make a kind of association behind the same one. The problem also is that everyone is coming with their own different backgrounds. Like the banks, for example, in Switzerland, it's very strict rules. As soon as you take deposit from the public, you become a bank. Yeah. But if you are a bank also, it means that you have to take people's deposit on your own balance sheet, and therefore take risk on people's deposit. When you look at non-banks actor, you can issue a kind of a stable coin by just issuing a bond. Yeah, you issue a bond that is a kind of rolling bond. Every month it rolls. Yeah, it has 0 yield, and actually at the end of the day, if you trust the company issuing this bond that they will do nothing with the money, it's like a stablecoin. Yeah, it works and it behaves exactly like a stablecoin, but because it's a security, it's a bond, it's unusable by all actors, because now if a platform wants to list this stablecoin, because it's a bond really contractually, it means that they need to be a securities dealer, yeah, and licensed as such. And in Switzerland, it's almost like a banking license in terms of complexity. So by coming with a real payment token, that is recognized and that is a liability against the bank, yes, there is a bank guarantee to it, and therefore the representation of this reserve is made through tokens, that would actually create something completely new for the industry.
Arnaud, that's such a great point, though, because stablecoins, like everything else, people use that term very broadly, and it means a lot of different things to different people. And a lot of stablecoins, depending on how they're structured, may very well be regulated as a security in different countries. And so we can call them a stablecoin, but the reality is that they may be something very different from a regulatory standpoint, which in turn limits the intended use. You can't use a coin for payment if different countries are regulating it as a security and restricting who can hold it, and imposing a lot of secondary market trading restrictions on it. It defeats the purpose of using it for an instrument of payment. And so, like everything else, we need more regulatory clarity in order to be able to figure out what is and what is not a stable coin, what is and what is not a security, and what is or is not something else completely different.
Definitely. And Kathy, what's your outtake on this?
I mean, I'm just going to echo what's already been said here. And I think it's just important that people should not just focus on labels, and that they really need to focus on the substance and what it's doing, what it's comprised of. The devil's in the details. I mean, people say that all the time, but in this case, the analysis can change with the slightest change. And, we are talking about global regulators in the space. What could be considered a commodity in one country could be considered a security in another. You have different regulations. And so it will be interesting to see how things pan out, and what direction people go in, and what carries steam and what gets propelled.
But there is one topic that goes hand in hand with regulation, is its compliance. So how do we make sure, how do players in the digital asset space, how they can make sure that they actually comply with these regulations? Because as you all mentioned, there's such a diversity of regulations. Like, it doesn't mean that you necessarily are following the regulations in one jurisdiction while you're operating like also in several others. I think this is a question for Matthew. How do different participants of the market can make sure that they are compliant and following the regulations correctly?
Well, I think it's, I'm sorry, I just changed my headphones, so let me know if there's any issues. But I think one of the key things, especially when you're talking about the DeFi community, that's important to understand with regulation. We kind of started, when we had to look at this, there's a philosophical debate about, how much is on chain, et cetera. And we kind of had to come to terms with two certainties when we started iComply, was that regulations are never going away and they're always going to be changing. And so when you start thinking of things, on chain, you have to be very careful about what you're putting on chain and where you're backing yourself into a corner, painting yourself into a corner where now you don't have the flexibility to, you start in the Swiss market and then you want to open up to the rest of to the EU, and all of a sudden, you're offside on compliance for those things. So I think what we think of from the tech perspective, a lot of times is the blockchain has an immense amount of, the ability to document what has happened. And from a compliance perspective, that's really powerful.
Mm-hmm.
But you can also end up documenting everything that went wrong. We just saw what happened with Wirecard. And I saw a lawyer in a compliance group that we're a part of in Asia who said, well, if this had been on a blockchain, we'd at least know what happened. And we kind of said, well, if it had been on a public blockchain, we would have known what would happen. And there's a reality of how we use this technology, and you see the ICO issuers from 2016, 2017. Well, now with blockchain forensics tools, regulators can just trace through, here's all sorts of illegal activities that are very easy to track and follow. So I think it's important to recognize that there's a double-edged sword to that, that level of transparency, and you want to make sure that you architect your solution in a way that is able to stay current with the regulations as they change. And the other thing is I just, especially depending on which market you're going into and what type of rules you're looking at, there's just some scenarios that software just can't decide the outcome of. And so it's very important that you have the ability to have things that escalate to someone who's an expert, someone who's a licensed person to make those types of decisions or perform that function of whether it's banking or custodial or performing a payment. The number of security token platforms we've seen that are performing a payment service, a custodial service, a broker-dealer service, and they hold 0 licenses for anything in any jurisdiction. And so it's important to understand that you may get a license in Latvia for a payment token, but that doesn't mean you can operate in Singapore. And so I think people have to kind of look at it a little bit. It's not just a tech decision. It actually starts as a business decision. What market are you going to serve? Okay, what are the rules? And then how do we deploy our technology in a way that if you can create a successful business, if people like the value proposition of what you're doing, if it's more than just a pump and dump, then you can build and grow in that market and look at expanding into others. But I've never heard of a bank that launches on a global scale on day one. You always with financial service, you'll want to start within one market and build a brand, or within a series of markets and build a brand, build a user base, build a business model, and then expand as you see opportunity in new markets. But I think one of the key pitfalls that we see, specifically with digital securities, is when we talk to somebody who's doing a token issuance and we say, okay, well, which markets do you want to serve? And they say everything but the sanctioned ones. We know that we have to get them in front of some sort of a compliance expert pretty quickly to steer them in the right direction.
To dive deeper and to make sure that we understand the topic of digital securities, and for our audience as well, we have a perfect question to go deeper into that topic. And it's what asset classes can be securitized as a digital securities. So, and is it different from what we can have as a paper security or traditional, normal digital security? Joel, would you like to take this one?
Sure. I think it's really an economic question, not a legal question. Any asset where the economics are such that it makes sense to fractionalize the ownership can be digitized and sold. And so whether we're talking again about a piece of art, whether we're talking about a commercial real estate building, whether we're talking about an airplane, if it makes sense to bring a group of owners together and give them a fractional ownership interest in it, and it is we're able to do it efficiently on a digital basis, then you can do it. And the real question simply becomes, as we've talked about already in this panel, what is that asset once it's digitized? If you bring in a group of people together, you've got somebody managing that investment on behalf of the group, and people are hoping that they're going to gain some upside because they've got an exposure on a fractional basis to that asset. We've probably created some type of collective investment scheme, and therefore those individual ownership tokens, or whatever we want to call them, are probably securities. But any asset is potentially amenable to fall into that type of structure.
I think that's the beauty of this, right? And I think that's why people are so excited. It's supposed to democratize and open what you're able to own in a way, So, I've been talking to projects where they want to tokenize, create an SPV where you're able to fractionalize minority ownership interests in professional sports teams in the United States, right? I mean, that's a big one. I mean, you're talking about something that's very illiquid. Professional teams, leagues, they have very, very strict rules in terms of who is allowed to own and when you're allowed to transfer. And if you're a minority owner, you could be stuck owning, your favorite team, but you need some liquidity, and it's really hard to get it. And so the idea there, is to allow, I think in this one particular instance, we're talking about accredited investors because it would be done under an exemption from registration under the U.S. securities laws. And so you would need to have accredited investors. And so you have to meet some sort of income or net worth thresholds. But the idea is that if you are a super fan and you want to own a tiny little piece of your team, you're not going to necessarily have an ownership stake in it. But maybe, if there is a sale or some other event, you can realize from a monetary perspective. But it's also bragging rights, saying, I own a piece of the Knicks. I don't know if I'd want to own the Knicks right now, but
no, you would not want to own a piece of the Knicks.
I'm a lifelong New York Knicks fan, so I don't know what that says about me. I think I'm just really stubborn. But it's just that concept where these are the things that a normal person wouldn't necessarily have access to, but all of a sudden you're giving access to things that have normally been out of reach. And I think that really
liquid assets. You just said that's going to be one of the real drivers, or this creates an opportunity for people to get exposure to illiquid asset classes that historically weren't open to most investors around the world.
Yeah, I think there's something, Joel, you kind of hit the nail on the head right at the beginning there, that it's an economic case. Well, what asset classes can be tokenized is really comes down to unit economics. And I think this is actually a really good point, as we've, I don't know what the pricing is today, but I know in late 2017, early 2018, you could spend $1 million to get listed onto Binance. It cost me a lot less to get listed on NASDAQ. As far as listing fees go, et cetera. And so, that's just your listing fees. What about the legal fees? What about, all of these components? So when we're early on in, look at the cost of computing a line of code in the 1970s and 1980s, mainframe computers took up buildings and costed millions and millions of dollars. Now, everybody who's on this panel has computers that are way more powerful than those multi-million-dollar infrastructure projects. And so I think digital securities is getting into a place where, if you want to call it Moore's Law or what have you, but there's a lot of this collaboration and infrastructure that's being built now. Is we're starting to see kind of a new phase where, it's not costing you. I remember early on in 2017, one company wanted, I believe it was at the time was 20 BTC, and we're talking 2017 BTCs, in order to assess your project for your ICO project. And if you compare that to the cost in the traditional investment banking world, if you were to go down that road, it's much more cost effective. So if we want to see this technology being used in more mainstream securities and mainstream asset classes being using blockchain, using digital securities, I think there's going to be a need for improving the unit economics in order to make it worthwhile. There's no reason why, you can't create, I think we'll get to a point where exchange will be, as Arnaud said, you don't necessarily, because it's decentralized technology, you don't need to necessarily create centralized exchange marketplaces. Especially when you're dealing with a lot of things that are typically highly illiquid, let's say early stage, VC funded companies as one example, or a minority ownership in the Knicks. These types of things aren't going to move, and just because you put it on a blockchain doesn't mean that all of a sudden people want to buy it. You still have to there still has to be some value to the underlying asset. If I take a really cheap piece of paper and put a share and write my share certificates on it versus a really nice piece of paper and I write my share certificates on it, it's still a share certificate. So it's a lot of the underlying asset is actually a big piece of the puzzle for this industry to really take off.
Some of it's just limited by imagination. We have a project, it's on hold now because of COVID, but it involved taking exposure to hotel properties, which is not unique, but using blockchain technology. What they were trying to do was allow people to actually take exposure to blocks of rooms within hotels so that you could actually pick a piece of the revenue stream that you wanted, so that they could tokenize different categories of rooms and allow people to actually, as part of a blockchain, drill down and see the ongoing performance and economic data with respect to those blocks rooms, and then trade it on that basis. And so there's some really cool things that we can do, again, assuming there's a market for it and economically it makes sense, but the technology is allowing us to really think about getting exposure to assets in completely new ways that in the past just weren't feasible.
I think, as Matthew said, it's also very about what is your audience, and at the end of the day, there was a lot of delusion, if you want to, on the tokenization platforms. They all thought that they would have like thousands of customers lining up, and at the end of the day, that's not true. Simply because tokenization is an enabler for liquidity, but it doesn't bring liquidity. You need to have people buying it and trading it, and this is the liquidity. And a lot of people actually had some misconception, because they were saying like, okay, I'm going to buy this super nice hotel in the city center of Zurich, and I'm going to tokenize it and sell it to the crowd. And then they realized that no one in the crowds wants that. And the reality is that the main buyers for those things are family offices, and they are institutional buyers. And those people are actually super interested in that asset class, especially in the context of today. They have to reinvest part of their assets into things that yield at least something a little in the context of negative interest rate. Yeah, and those institutionals are super interested in those assets, and those people are actually presenting it directly to the crowd that doesn't want that, because they do not understand what they are buying into. And at the end of the day, this is all about bridging those two worlds. Yeah, so there is the traditional world of traditional finance, so-called ISIN, identification for security numbers. This is the norm in like any securities account that you might have at UBS or Bank of America or whatever. You want to buy Nestle shares, you want to buy shares of any company, it's represented by this identification number, and it's traded maybe on the New York Stock Exchange, or it might be traded on the Vienna Stock Exchange, whatever. But at the end of the day, this is international norm. Now, if we can bridge those two worlds by allowing the company to actually have, for example, its equity on both sides, part of it is tokenized, part of it is on the traditional side, and the company arranged the change of form, meaning that any point in time, an investor on the traditional way, meaning that they own your shares in their securities account of their e-banking, they can come to the company and say, I want to exchange that for tokens, and opposites. The token holders can actually come and say, no, now I want to exchange my tokens for a position in my e-banking. And this actually bridging those two worlds, I believe, is the next step to actually have money flowing more onto the token side, because institutionals will now understand how powerful it is, because they can share on the same network with a lot more people than just the happy few. Yeah, and this will happen only when we have those bridges to be opened and fully freely, I would say, transferable between one form to another form.
I think all of you, in this past several minutes, mentioned a really important topic that goes hand in hand with digital securities, liquidity. And I think when we were also talking about security token offerings, and apparently there is a difference between security token and digital security, the promise of liquidity, the promise of something that actually can be like magically tokenized and now it's magically liquid. It wasn't fulfilled, and apparently there was some disappointment around this in the market. And what we see now, basically, with Open Finance, and this was one of the few actually places where the security tokens could be traded. So what exactly do we need for actual liquidity on this market? How should this work? And does it mean, since we don't have liquidity yet, is it a problem, or it's just still super early stage and we're actually getting there slowly? Who would like to take this one?
I can I've got opinions on this one. I think liquidity is a chicken and egg kind of a scenario. We've seen this for the last 2 years where somebody says, I'm interested in tokenizing my equity, this corporate bond, or, whatever the asset is, but where is it going to trade? And then you talk to people who say, well, we're thinking of launching a digital asset or a security token exchange, but we're just waiting for the market to catch up. We're just waiting for more issuers to be out there. So it's a multi-sided marketplace, and getting everyone to come together, especially when they're disagreeing on which protocols are better and all this stuff, can be a real challenge. So I think one of the biggest points towards liquidity is actually more industry collaboration. One of the things that Arno mentioned earlier around having stable coin or what I would call cash equivalent type of accounts that can function on chain make for a much more efficient, much more transparent type of a peer-to-peer transfer, of DEX transfer or centralized exchange transfer. But there's also the FATF, Financial Action Task Force travel rule was something that was kind of rolled out for virtual assets, cryptocurrencies per se. But this is actually a pretty significant limiting factor towards liquidity in private securities markets as well. And so as this standard is rolled out for even things like virtual assets, I think it's going to actually impact the liquidity opportunity for security tokens, because all it is a common messaging standard of who's the person buying, who's the person selling. And if you can't agree on the naming convention of the first and last name, the dates of birth, is it the year or the month first in a date format in a technological world can be a showstopper. So as the industry starts to adopt common standards, it's no different than the dawn of the internet. As we saw common standards emerge, we saw people starting to build on top of those, and real innovation started to occur. So I think I think those are some of the big limitations. We already see things like Carta, NASDAQ, private markets, with back in the day, Marco Polo, trying all of these same things. There's a lot of people that are trying it. It's not necessarily just technology. It's more about making sure that such a multi-sided global financial marketplace can actually start coming together in one place.
Yeah, I have some clients who believe, the path towards liquidity is standardization. So when you're dealing with digital asset security, we have, when ICOs came out, you had the ERC-20 standard. You have a few other standards right now. I think, still sticking with the US and focusing more on the private security side. And if things are done via exemption from US securities laws, we're talking, Reg D type things. I think people are seeing that if there is standardization and there is a way to use smart contract coding to, plug it, to kind of refine which jurisdictions your investors are from, whitelisting investors who is able to buy them, and then once any transfer restrictions expire, holding periods are up, then you have another whitelist of potential transferees. The other idea with standardization is that once if one or a few standards are adopted, that the different platforms are able to talk to each other. They know exactly what they're talking about in terms of how holding periods are calculated, or what the onboarding requirements or restrictions are. And on top of that, I think when you're talking about interoperability is key too, right? And I think that kind of goes hand in hand with standardization, and that's something that people are very much focused on right now. I mean, I don't have a crystal ball, and I don't know if that is going to turn the switch. But at the same time, it makes sense, right? I mean, you want to make sure everyone's talking and comparing apples to apples, and so that's potentially one way forward.
This is actually very interesting, and this is exactly what we actually push in Switzerland, is to have that kind of standardization. This is everything that we try to explain to banks in general. Why is it so inefficient? If you look at the trading floor, you have one center of profit, which is the trader, and then you have 10 center of cost behind, yeah? Middle office, back office, risk reporting, settlement, netting, confirmation, reconciliation, and all those departments exist actually for one reason, is that bank A and bank B, institution A and institution B, do not trust each other. They have their own ledger, and they modelize basically the contracts in their own way, in their own core banking system. And at the end of the day, the important aspect is that all banking assets are contracts, yeah? And if we agree on a modelization of such a contract in the form of a smart contract, at least for its simple forms, you can actually get rid of a lot of operational costs. You can have actually a kind of shared, mutualized back office with all the institutions that would be the blockchain. And that actually is the opportunity now for banks. And especially I'm speaking about Switzerland in particular, because yields are going down, operational cost is going up. They have actually, you know, all the compliance aspect and everything is like putting a lot of burden on the banks. And today they can't increase margin anymore. So the only opportunity they had is to decrease costs. And this is actually what we actually try to explain to banks. So now we are doing dry runs with them to actually show how we can incorporate any type of securities they have on their book and to have it into a token to show to them how we can make transfer from the simple issuance to the transfer between a startup company and a bank, and that on the same network you can involve institutions, startups, as well as private individuals that all have different rules to interact with, simply because it's a token. It's an ERC20 token, by the way, because we want to have interoperability, but we add on top of it, obviously, a rule engine. And this rule engine actually manages the life cycle compliancy of such tokens. And obviously there are clauses of the contract that cannot be determined by the smart contract. So you need to have the so-called compliance oracles on that network. Yeah, compliance oracles can actually be really well fitted by banks. This role could be very well fitted by banks. And actually, even in Switzerland, you can delegate your compliance. You know, as a bank, you can say, I delegate my compliance to UBS or to another bank, because they're all bank grade and they're all supposed to have the same level of compliance. So at the end of the day, banks could actually very specialize on that aspect, and some others could use and pay them to actually manage the life cycle of any tokens they would issue. And this is what we're trying to show in real life to different institutions.
Yeah, so there are two things that have to happen for this market to move forward. One is that we had a first generation of crypto exchanges that grew up in a period of time where this space thought that everything was beyond the concept of existing regulations. And so you had all of these exchanges and trading platforms that said, well, the tokens aren't regulated, we don't have to be regulated, this is new technology. And that wasn't unfortunately true. And so either a lot of these existing platforms have to bite the bullet and recognize that if they want to participate in, for example, the world of trading digital assets or digital securities, they either have to become regulated or they're going to be replaced by platforms that are willing to be subject to the required regulatory regimes in different countries around the world. The second aspect is that, again, in the early players in the crypto and blockchain space, they focus a lot about peer-to-peer activities where they say, we don't need intermediaries anymore. We don't need all of those existing old-fashioned players. Well, from a pure technology standpoint, a lot of that may be true, but regulators globally aren't willing to simply, give up on the notion of having regulated entities participating in the ecosystem. And so we have to get beyond that philosophical debate and recognize that whether we're talking about, an approach that Arno just mentioned or some other approach, there are going to be players that are regulated that are going to have to be inserted within the ecosystem in different points along the chain in order for us to get regulatory buy-in and in order to be able to create a market that truly does go from one jurisdiction to another. And so people have to be willing to accept that there are limits on what blockchain technology can do from the standpoint that regulators are going to still impose some type of old-fashioned intermediaries throughout the process where necessary.
I think one of the things on that point is that there's, it's actually no different than paper securities, really. There's nothing, shares in my company, as one example, I could sell those shares directly. I could, if I had a paper share certificate, I could go and make that transaction peer-to-peer. That paperwork would have to get handed off to our lawyers. They would go and make sure everything's processed, etc. But the reality is you can do that today in a paper-based securities world. You can do all this stuff, quote unquote, peer-to-peer, just like you can with the technology. just because you can do something doesn't always mean it's a good idea. And there's definitely what I like that I'm seeing from a lot of regulators is there seems to be a line being drawn between who are you acting on behalf of? If you choose you want to make this transaction, you want to do it peer to peer, you want to custody your stuff in your own wallet, and then you have that level of flexibility, which we've never had before. You can't do that in the current financial services infrastructure because the tech is it's not capable of supporting that. But at the same time, I just can't imagine my grandmother trying to remember her passphrase or her private keys to her wallet. So if she wants to start investing, if we are going to move all these assets over onto blockchain-based infrastructure, there has to be a usability. What we've said, in our product team is that it's important to remember that the iPod wasn't the first digital music player. And it started to make the ease of use. It started to really gain that, get that level of adoption. And a big part of it is really making it, lowering the bar. So you didn't have to mess with torrents and MP3 files and all sorts of stuff. And now you can have a much easier use case. And I actually see there's a couple of things in the comments from different people in the audience. I'd be curious to kind of hear from different countries. We operate in quite a few different countries in the world, both in the traditional and in this the new this new decentralized financial market. But I'd be curious to hear different people's thoughts on the markets that are a little bit easier, maybe, or a little bit ahead on the regulatory front. A friendly environment for a fintech versus maybe a little more onerous.
Well, I mean, this is kind of loaded because it depends on what aspects are more onerous and which ones are more friendly. I think if it's in terms of a licensing regime and where not that New York is a country, but New York has onerous requirements like the BIT license, right? And a lot of people avoid New York because they don't want to go through the process, or they don't have the means to meet capital requirements or other ongoing requirements needed to maintain that license. There are some jurisdictions that deem themselves to be crypto friendly, and they say, come establish your exchange here and we'll do it. But if you can't access certain markets, what good does that do for you, right? To establish yourself somewhere, unless you just want to get up and running somewhere, right? And test a use case. I mean, yes, then there are definitely jurisdictions where you can get up and running and figure out if it's going to work. If you're trying to figure out if in the end your gameplay is to have a global token or a global product, or to be able to operate on a global scale, it doesn't matter if there's one friendly place because the others aren't.
You have to comply with the regulations where your investors are, not where you're based.
Right.
Absolutely. And I think what you said, Kathy, on this topic is important to, people will look at this and say, okay, well, I understand securities regulation. So, therefore, I know this market, I understand how this works, but maybe they don't understand that they're also subject to things like data privacy, data protection. There's regulations around identity verification. There's regulations around anti-money laundering. And, those can all be very different. When I look at markets, like here in Canada or in the US, which are on a regulatory perspective quite similar, I would say one of the biggest challenges is our markets are actually really fragmented, and that kind of goes back to this BIT license conversation. I have a New York license. Look at Coinbase. They have, I believe, 24 or 27 different licenses to operate within different states. Money transmission, money services business, state by state reporting. Some states, if you have a transaction that hits this threshold, you have to report within a certain number of hours or days. Others, you have to file a report once a month or once a week or once a quarter. And there's no real way to operate within that whole market under one umbrella. And so it can make those markets actually really complicated. One of the things that I see, as far as jurisdictions that are easy, we take a different look at easy than some people. We had a lot of people that were very excited about Singapore early on. We were always a little bit, I think there's a lot of reasons Singapore still is figuring out some of the regulations related to digital payment tokens, related to custodial, and there's even within the regulations themselves some conflicts. So while it was a very friendly blockchain jurisdiction, it still comes down to the regulatory piece is maybe not there. Whereas when you see certain markets like in Europe, there's been a move way before blockchain towards standardization across the EU. When you see what's happening in the UK, and so from some of the jurisdictions that we see things, from on a regulatory basis or from the regulatory perspective being a little closer to ready, I would say places like the UK. Canada is actually quite good for the projects that have actually, gone through the hoops of talking with the regulators super early on, and realizing that just because you launch out of BC or Manitoba doesn't mean that you can access the entire US market. You still have US regulations to deal with if you want to take on US investors. But we've seen some projects that have done really well in these jurisdictions. Switzerland is obviously another one in the digital asset space, and as Arnaud mentioned, there's a lot of movement towards the digital securities. I know SIX is doing a lot of lobbying in that direction as well. But there's a lot more than just one rule book to look at, and I think it's going to take some time before we start seeing 5 or 6 jurisdictions emerge that actually have the railway tracks in place for people to start transacting among these jurisdictions more efficiently.
So we've never had in capital markets or in financial markets a single global regulatory standard. And so it's not going to happen in blockchain any more than it is in other markets. But as this space matures, I think what we will see, again, comparable to where other markets have gone, is attempts by global regulators to try to harmonize and come up with at least comparable regulation. So a good precedent is looking at the derivatives market, especially what happened after the financial crisis, where globally countries said, let's try to create some common principles for how we deal with derivatives, and each country is going to implement their own regulations, but let's do what we can to harmonize. And then different regulators got together and said, if your regulation is comparable to mine, we'll let you operate on that basis. And I think we will start to see that in this space, especially because the technology does give us some interesting tools to create those attempts to harmonize and create comparable approaches in a way that historically we haven't been able to. But that will take time. I mean, to me, that's 10 years at least.
Wow, I wouldn't even give it. I mean, I would say that's being ambitious and optimistic.
Well, I'm hoping the technology will make it a little bit faster.
Yeah, I mean, I think if you look back to, it's a point that Arnaud brought up before, just in terms of, different institutions being able to trust what the other has done. Maybe it's from an onboarding or KYC perspective. We've seen, even a few years ago, DTCC put together a consortium a few years ago where they tried to almost, crowdsource or to be able to rely on other financial institutions onboarding processes. And so you kind of have the central depository where if you KYC, one legal entity, the people in the consortium are able to rely on it. And that's something that we would probably want to see. I think that would help facilitate travel rule and things like that. And so while the financial institutions who are part of the consortium really were on board with it and they wanted to make it work, their conversations with different regulators kind of stopped it, right? Because the regulator said, sounds good, but if you want to be in compliance with your requirements with us, you can't rely on them. So, right, until you get regulators to buy in on that type of consorted effort, it will be a little bit difficult.
Well, I think there's a bit of think of it a bit in game theory. Any of those networks are only as strong as their weakest link. Because if you have one person who's willing to, to slide in, the that one lawyer in Panama that's just, building all these companies, you weaken that entire ecosystem is only as strong as its weakest link. And so there, we've seen this in, DTC's example. There's been many plays in this area in Canada right now. The DIAC, one of the DIAC founding members is SecureKey, which is an RSA project. And, they've successfully implemented between the tax authority, the top 5 scheduled banks, quite a few other financial services. So you can share, you have your portable KYC. The problem with that is that the liability, and I actually think that this is a good thing from a regulatory perspective, but if Bank 1 onboards someone, and then that person takes that account and portable KYC, uses that at Bank 2, and then decides to start using Bank 2 for money laundering. Bank 2 is the one who's held accountable for that. And I think there's one, people need to understand, if you're talking about KYC, the concept of KYC being onboarding is, it's like saying a car is a bumper. It's just the first little tip of the iceberg. And, the having this 360-degree view of your client to understand what is the purpose of why they're using your financial service is kind of more what you're needing to do with KYC. So the challenge that we see with a lot of these networks, SyncPass in Switzerland, some of the other countries where central banks are working on these exact same type of initiatives is, aside, or even Aadhaar in India, there's a technological component to it, but then there comes this whole liability and trust piece. So I do think that when you get into, and this is very in our wheelhouse, into the areas of ID verification or KYC, customer due diligence, things along those lines, I think we're going to get to a point where we see a little bit more open standards, because that space is very dark and obfuscated. If you look at a lot of the players in the US market, or even some of the major players in the Canadian market, they try to use their tech in the US market, and it doesn't work because it's not compliant for the US standards. And I think what we're going to see is a lot of this technology starting to move, at least even with what we're moving towards, things like zero knowledge proofs, and using some of this decentralized technology to identify who people are, but also provide proof of how the identification was performed. Not just saying, hey, we KYC'd them, but we performed this type of a check. And that at least enables people to have a little bit more trust and confidence. It's kind of no different than social media and the problems that you see with fake information being shared. Somebody posts it gets a bunch of people excited, they start sharing it, it goes viral, and it's all fake news. And so that, before it even somebody finds out, oh, I shared something that was, that was wrong, I'm going to pull that share down. Well, it's already being propagated. And that's actually very much the same problem that finance has with this interoperable KYC kind of a concept. Is you need to also validate the validators, and you need to be checking the checkers. And until we have that level of transparency, and this technology can do that, I think we're a long ways away before we can have this, one country having an actual working KYC standard. SyncPass, as an example, in Singapore, is something that they are planning to deprecate because of the challenges.
We have a question from the audience about standards. What is the path forward on compliance if there are over a dozen proposals on standards for the travel rule? Will there be multiple standards, and how does that impact tokenized securities rollout? Arnaud, would you like to comment? Oh, sorry.
Yeah, I think that for sure we will have multiple implementation of those travel rules. We already see that. I mean, we are part of an initiative here in Switzerland to work on that. The problem is also, and always the same, is the entrepreneur's ego. Yeah, and each and every entrepreneur wants to come with their own, and at the end of the day, now we see good initiatives of people saying, look, if each and every company is thinking that they have the right implementation, let's, have a kind of central place where we actually connect them all. Yeah. And therefore we can make a kind of translator in real time between those different connectors so that all institutions can talk to each other, even though they use a different implementation of those travel rules. And I believe this is what will come up. And at some point, at the beginning, it's always like that. The market is super fragmented. At some point, there is a clear winner because of efficiency, because of track record whatsoever. And for whatever reason, there is a network effect and people start using mostly one and starting to abandon the others. But right now, we're exactly in this fragmented situation, yes.
Mm-hmm. I think in regards to the travel rule, just specifically on multiple standards in the travel rule, there's a lot of merging. I know, the Open VASP initiative. I actually saw a new one that I had never heard of this morning that people were talking about in one market, and they keep popping up, and it is I would agree it's people reinventing the wheel. They're all accomplishing the same thing. The regulators aren't going to say this is the standard to use. It's a market decision on the technology. And so I think what we're going to see is actually, it could very well likely emerge the same way we have different electrical standards in different markets. We have 120, 110, 120 volt in North America. Europe's on a different standard. UK is on a different standard. And you see these things kind of emerge within those markets, and you don't have these interoperability. What you now have is these little travel adapters, and I think that'll be very similar. We'll see maybe Coinbase and a bunch of their buddies are all going to roll out their thing that they're going to use internally, and then some security token network and with stable coins is going to all agree onto theirs, and eventually, like we saw with standards on the internet, we'll see some leaders emerge, but that's going to be, the market will have to make those decisions. Interestingly, though, the last part of the question from Megs here says, the impact on tokenized securities. And I actually don't think there's a huge amount of impact other than that by having a standard emerge, we will have more interoperability and more opportunity for liquidity. But due to the nature of securities regulation, there's nothing in the travel rule that's additional to what you have to already track. There's very few markets where you can have bearer instruments anymore. And so, I don't think there's going to be a huge impact as far as the travel rule, opening the door for digital securities more than they're already, than you can already do today.
Going to the next question from the audience. We're going back to liquidity and trading. What are panelists' thoughts about trading securities on public blockchains versus private, and Lightning as an example?
I would like to say something on this one. I mean, personally, I'm not going to say we. I would say I personally think there are only very little and very few use cases where private blockchains make sense. To be honest, most of the private blockchains initiative that you see today can be totally replaced by a central server and a standardized API. And at the end of the day, when you have a private network where only the happy few have the keys of it and can decide for things, then that's the same of having a consortium or an association running and delegating to a central server the ability to pass on messages and to clear messages whatsoever. So the idea of having a private network really is not a good idea. I mean, there are a few use cases where it can be interesting, but the real interesting aspects of incorporating securities into token is actually the interoperability with the rest of the token economy, is the distributability, the openness, the fact that people can be self-custodian, or if they don't feel like they can delegate the custody to the regulated institutions, etc., etc. So that's my personal belief. Maybe some others.
You're right from a technology standpoint, but now think about it from a regulatory standpoint. If you're going to trade securities on a public blockchain, we can't go back to anything, Kathy, maybe you said this earlier, you can't have to worry about people losing their passwords. You can't lose your securities because you don't know how to protect it. So you're going to have to impose overlays on a public blockchain, like having a regulated transfer agent that has the ability to replace lost keys so that you don't lose your securities. And so even if we're talking about public blockchains, we're not talking about them the way that we think about them today. I think we're talking about somewhat of a hybrid model where you're overlaying on top of that public blockchain some of the institutional roles that would be more consistent to what we would characterize, as being a private blockchain, in order to meet, regulatory requirements.
But my point is really that the private blockchain is useless in the sense that it's not interoperable with the rest. And at the end of the day, you're adding a layer of complexity to your system that is not necessary. Again, I mean, what is a blockchain? At the end of the day, it's a fancy database. It's just a database, right? So, I mean, running a database on a centralized server and opening up an API that is standardized is a lot more efficient for any players to connect and to maintain and to evolve over time. And in terms of speed, instead of cost, in terms of everything, it's a lot more efficient to run it in the form of a centralized server with an API. So I agree that for some few use cases, private blockchains can be interesting because, like some in the commodities industry, people do not trust each other, yet they have to deal with each other, and they want to be kind of a secretive, kind of secret type of environment, etc., etc. But other than that, really, it's very hard for me to see a good opportunity for securities to be put on a private blockchain.
I mean, I think that's why you're going to see a lot of technology companies. So TokenSoft with their ERC 1404 standard. The idea here is that it's an Ethereum-based token. You have smart contracts embedded in it, so you're able to see everything that an ERC 20 does, but you're able to add restrictions on top of it to comply with private securities laws. But the idea here is that the public blockchain is still the main record, except in this case, an issuer can give administrative rights to a transfer agent or someone else.
Exactly.
And in the event that there is, and just kind of going to some of the SEC's concerns with digital securities is, if you lose a private key, then it's gone, all these concerns for investor protection. And so the idea with the ERC 1404 is that an administrator can go, and once they do an investigation it's deemed that, the keys were lost, stolen, securities were sent to a wrong address. They have the ability to kind of correct and revoke and then reassign and reissue digital securities, and then kind of adjust the records on the blockchain. And there, it's definitely making use of the public blockchain here, except you're using technology through a standardized token to add a layer of something akin to more of a private blockchain. And so maybe in order to kind of get people to move forward and to do things, you have that balance where you have the public blockchain, but you have an administrator who's able to do things on the back end, but then it's all reflected on the public blockchain.
I think that's, the conversation or the question specifically of public versus private. I would agree, Arnaud, that with your comments that we've had private blockchains in pretty much every sense of the word other than massive expensive mining power since the 80s. That level of public-private key infrastructure has been around for a long time. It exists. It's already used. These private networks, you could argue that things like the FIX protocol, as an example, really tie into very similar what the travel rule is looking to accomplish today. So the benefit of a private blockchain is that there's definitely a transitional period, and we see in the last, I would say, year and a half, we've seen a whole bunch of projects enter in with private blockchain solutions, etc. But I think it's important to look, again, going back early days of the internet, look at what Red Hat did, and by the open source standards, especially when you're getting down into money, when the open source standards, like I said earlier, cost $1 million to list on Binance, there's no benefit to going open source. But when you get down to the point where there is there's no trade fees, there's no, tokenization is clicking a few buttons rather than, spending nowadays, a few $1,000s on software development. But, as these things become more and more streamlined, whether you use a 1400 or a 1404 or a 223 or 721 ERC 20, isn't really, they all can do the exact same functions. A lot of those standards that emerged, were very much marketing related. The ERC 20, the functionality of being able to enable validators, being able to have key recovery, asset recovery, it all exists. In fact, things like key recovery, is more of a wallet-centric issue than it is necessarily the token, depending on the architecture. But I do think that the infrastructure, the pace of development and just look at the Ethereum Enterprise Alliance, look at what's happened with a lot of these private networks. They've really moved. They're moving to the point where you see JP Morgan basically, stepping out of the game. They built Quorum, they patented Quorum, they spent all of this money towards it, and then they handed it off and said, hey, let's put this back in the Ethereum community. By on the flip side of the coin, as an alternative approach, look at what Microsoft did with Ethereum proof of authority nodes, and you see them creating infrastructure to support the open source community. And what a proof of authority does is, even in the case of some of the projects we've worked on, creates essentially a backup of the public chain, and that's just really, the idea of a blockchain going rogue is theoretically nearly impossible. But to have a backup to say, hey, in the event that the blockchain does all of a sudden fork and go completely the wrong way, and you actually have the ability to have a backup that you can roll back the network to that specific point in time. And so I think the ability, any of these scenarios, some of the projects that we're involved in include your regulatory tests where, okay, well, we want to see an asset recovery. We want to see buy and sell side rule sets that are different because across different jurisdictions. And when you see these things kind of all coming together, it is the public chain technology is able to perform all of those functions. Now there is definitely complication where you have to, like Joel said, you have to have some sort of a permissioning layer, but that actually is more on the smart contract level than the blockchain level. And when you're dealing with, when we just see what Mount Pelerin is doing, what we've been working on for several years, TokenSoft's on Ethereum, Polymath is, I guess, no longer on Ethereum, but they started there. Tokeny, all these different networks. More and more, you see things kind of merging towards very common standards within that 1400. Securrency's Cat 20 is very much like a 1400. And so we are getting very close to the point where there are only a handful of standards that make any sense. And I think that when we're getting down to just the core thing of a transaction cost, most people don't realize, because we have quite a few different companies that use our platform for different types of token standards for compliance, we had to build a scaling layer that we rolled out in 2018. So you can batch thousands of transactions into one transaction processing fee. Well, all of a sudden now this whole concept of, Ethereum gas is expensive. Who cares? If you're splitting that gas cost with 10,000 other transactions, who cares, right? It's a non-issue compared to any of the other time that you're spending. But when you're looking at these networks and how much does it cost to build a private network compared to how much does it cost to process a single transaction on Ethereum? One of the companies that we worked with built a private network on an R3 infrastructure, and after 3 years, it's institutional only gold traded token. It's operating in several jurisdictions, custodied by government backed custodial agencies in their jurisdictions. And they said flat out, we can't afford to keep up with the pace of innovation on Ethereum. We have to move to Ethereum, or we're going to be passed by someone who's going to raise, $500,000 instead of the 35 million they raised. They're going to raise $500,000, take a bunch of technology, maybe work with Mount Pelerin to set up a few things, maybe get their compliance from iComply, and next thing you know, they're now dealing with their lawyers to get the legal contracts in place, and they have all the infrastructure for less than 1% of what somebody who went on these other networks. So I actually think that the private blockchain stuff will continue. It'll continue to grow in the near term, and we'll see it start to sunset in the 5 to 10 year range. But it requires the open source community to get a little bit of, stop reinventing the wheel and start building on top of each other's technologies a little bit more. And the faster we do that, the lower the cost is for everyone. The unit economics of issuing a security, trading, Any of those things are going to be, I think in the next 3 years, we're going to see technology emerge in the DeFi, the open source public chain space, that it's just going to be really hard to justify the build your own private network argument. And that's, very much an opinion, but that is where I think we're going.
This is a very comprehensive overview for 2020 and beyond. And Joel asked us to focus on beyond only. So since we only have a couple minutes left, Joel, would you like to give your perspective of what's happening beyond? Matthew just said like what he sees coming in the next 3 years. What do you see coming in this time frame?
Well, I think that regardless of all the challenges we have now, we're recognizing where moving things further down the digital chain are going to create efficiencies, reduce costs, speed up transaction time, eliminate some of the historical intermediaries that do nothing but suck out fees and slow down trades. And so that train's left the station. And while people are frustrated that maybe a lot of the infrastructure hasn't come online as quickly as we thought, and that they thought that we could bypass archaic regulations, none of that is true, but it doesn't mean that we're dead in the water. We're moving forward. If people are patient, we're going to start to see, again, standards emerge. We're going to start to see a next generation of players out there that are more mature, more sophisticated, more willing to adopt and comply with regulatory requirements as opposed to simply trying to bypass them. And all of those things will allow us to start to create a more mature market that then brings in product, opportunity, liquidity. And so if you look at this over, the next few years, I'm really optimistic about where we're going to go. People just need to be patient because it's going to take a while to get there.
Kathy, what do you see coming in the next couple of years?
I'm if it wasn't obvious before, I'm incredibly bullish on the space. I think we've gotten past the point where you're trying to defeat or kind of quiet the naysayers. I think it both on the more blockchain focused side and on the crypto focused side, they're both moving ahead. There are what I've seen a lot, especially since since the beginning of 2020, there are a lot of more traditional players who are very interested in blockchain and crypto and want to learn more. I think for people who've been in this space for a while, you're not doing your job unless there's also an education element to it, right? So you're constantly going out there, you're educating people, you're telling people what's going on. Now more and more people are seeking out that education and really want to learn what it's about, not just to kind of learn the buzzwords and just try to get a handle on it, but actually how to engage in the space. And I think that's a difference. So as Joel said, it might be a little slow. I think if you look back and look at things in hindsight, you'll see that we're actually moving pretty quickly. It just seems very, very slow right now as we're living through it. And I think, you also have people who've been around since 2016, 2017, kind of came in with the whole ICO craze. And they now know that the priorities have shifted, and you have people who have learned so much by just being in the trenches for the last few years. And I think they're really not ready, but they are putting their heads down right now to try to think of and push forth standardization, interoperability, just trying to move this space along after having gone through the growing pains of the last few years.
Arnaud?
Yeah, on my side, I will maybe separate two views. One is on the institutional side, where the good news is, at least from a European and a Swiss point of view, things are moving forward. Institutions today, they all understood that they need to do something. Last year was mostly about doing proof of concepts all the time, just for the sake of doing proof of concept, blah, blah, blah. This year, we see that they are moving from proof of concept to actually putting one of them into production. They are actually slowly, really slowly, but they are embracing this world. They are like we see now a lot of banks in Switzerland actually getting equipped for custody, you know, for digital asset custody. They are training staff. They are putting processes in place that they are putting that, you know, all those processes have to be supervised by FINMA. So they say, look, this is the disaster recovery plan. This is how we intend to make backups. This is how we intend to process the human risk. This is how we do the key ceremony. This is all this and that. They're all getting into that in a very bank grade, I would call it. And it's very interesting because now they want to test. Now they really want to have like a real use case. They all understand that there is no market today. Let's be honest, there is no market today. The reality is that when a company tries to tokenize its shares and sell it to the public, some of them believe that, you know, people will just buy their shares because it's tokens, but it's not true. I mean, the hard job of marketing is always underestimated. And at the end of the day, people do not really trust a newly formed startup with their savings, right? So at the end of the day, you better invest into something you understand better. The reality is actually here. But on the other side, there is the ecosystem of retail and SMEs. And my personal view is that each and every SME in 15 years that will incorporate on the blockchain. And that's actually a bet that I can take today in 15 years. I mean, today, if you want to do that, you first have to incorporate the company traditionally, and then you can incorporate your shares into tokens. Yeah, it's a two-step approach. Yeah, you update your bylaws of the company in order to recognize the tokenization. That's how we do it in Switzerland. You have a board resolution, and then you can do it. The commercial registry update that, and it's done. Yeah, so legally speaking, your shares are tokens. In the future, why I'm saying that every company will incorporate directly onto the blockchain, simply because today all the management, all the administration of a company is extremely manual, is extremely paper-based. And today, by actually bringing a lot of this administrative work of managing the company onto the blockchain, such as, you know, like tomorrow, for example, Mon Pèlerin is going to conduct the very first General Assembly of Mon Pèlerin. Yeah, so we had a long exercise of 1.5 years. So tomorrow we have a General Assembly. Obviously, it's a digital general meeting. We have like 640 shareholders that will join this general meeting, and they will be able to do that via the wallet directly, meaning they will see the live stream inside the wallet. They will be able to vote according to the amount of shares they have directly within the wallet. And everything is actually very interesting now to see how you can make a cockpit for companies to manage and administrate their company when it comes to managing the cap table, when it comes to managing the future corporate actions that you might want to do. You know, maybe you might want to do capital increase, you might want to do stock split, you might want to do different things like that. And all that, if it's managed within the cockpit digitally, we truly believe that it's going to be a game changer for SMEs that today spends too much time, effort, and money onto administration of their own company, especially in Europe. I don't know how it is in the US.
I actually, just to add to that, I very much agree. I think there's, you know, even the concept of, you know, requiring a transfer agent for any company that uses a blockchain-based database. You know, we don't, in private markets, we don't need transfer agents. And I think that due to the transparency the technology can provide, if you have the infrastructure set up properly and you bring in the right players. Now, today, I think a good example is to look at the small cap VC market. I actually don't know of a VC that manages their back office themselves. I actually cannot think of a single one, but they're using, you know, they're using different sort of fund administrator or trust corporate services firms typically to kind of handle a lot of this processing. And I think it'll be as the workflows become easier, it might be that SMEs take it on themselves. You know, they have, you know, hey, here's your whole rule book and templates and everything set to go for the Swiss market. Away you go. But I think we're going to see, you know, Joel mentioned earlier that not all intermediaries need to exist. And that part of the equation, I don't think has been sorted out yet. You know, you see the exchanges, DTCC has digital securities sessions, and, you know, NASDAQ has this, and, you know, everybody's got their, you know, whether it's a transfer agent or an exchange or a custodian, you know, everyone's clearinghouse, everyone's kind of, you know, putting in their piece of why digital securities will transform things. But what a lot of people aren't mentioning is the fact that you probably only need 1/3 of those players in an infrastructure where you don't need to reconcile overnight my database against Joel's database, because we're using the same database and we agree that we're going to use that as our source of truth. And now all of a sudden that's a lot of efficiency gain. And it's going to be these pieces, like what you're talking about, Arnaud. I wish I was a shareholder just to see the virtual AGM in my wallet. That sounds really cool. But I think there's going to be some testing. It's kind of like even this channel that we're using here, streaming over YouTube and Twitter and a bunch of different networks. Everybody's moved remote. And I don't know about you, but for us, we spent a lot of time in the blockchain scene, going around to conferences in the last 2 years, and now all of a sudden everyone's doing has Zoom events. But the concept of a remote conference hasn't really been sorted out. I don't go to most conferences to sit there and listen for 3 days to the people on the stage. There's a few talks that I'll definitely go and check out, but I'm spending a lot of time networking with people, interacting, building relationships. That's a big reason why we as a company, pay our team to go to conferences. And so I think there's a similar example where, yes, we can meet here, but to recreate a real conference experience in the video networking world hasn't been figured out. And I think it's kind of somewhat analogous to what we see in digital securities. Is the secret sauce, the magic formula hasn't quite been figured out yet. And once we do see it, I think we're going to see it start to roll out very quickly. It's going to just make a ton of sense. You saw the iPhone, you saw the iPad had a 2-year adoption cycle. Things like e-signatures rolling out country by country had a huge amount of regulatory challenges. But now it's because of COVID becoming something that is being, law societies are updating their rules around remote signatures. And so there's a whole bunch of factors, whether it's things related to remote work and COVID, whether it's the regulatory change that was already in the pipeline for 15 years and is starting to come through, or whether it's the advent of some of the stuff with blockchain. We are kind of coming to a point now where it's going to be about figuring out how to really serve the market in a way that the market likes, that the market will adopt, and understanding that the stakeholders and the needs of the investors, the back office services firms, or even the issuance platforms or the companies who are doing the issuing themselves, that it's starting to seem to sort itself out a little bit more than let's say it was in 2017. And I think that's going to be something that we're going to see a lot more growth. And there, on this point, there was one question that asked about the size of the market, and I know we know the market is small. We say it's less than 1% of capital markets, but we don't know the size. Our issuers, less than 5% of the companies we work with do a crowd sale. There is no token. They never list their token on Token Market or any of these places. It's a private family office type of transactions, very similar to what Société Générale did in France, where it's the bank trading with the bank. They're starting to implement this infrastructure, and what's happening in 2020 behind the scenes, there's a huge amount of building. But I think once that stuff starts moving out of these POCs into real world examples, and we have real world use cases that actually are more efficient, by more cost effective than what's being done in the traditional sense, that's the only time the capital markets are going to make a move. If it's more expensive, and hey, look, it does it better because it's on blockchain, but it's more expensive, financial markets don't have the margins to just move to more expensive tech. It has to provide a number of benefits, including cost savings.
Thank you very much, everyone. I think we're out of time for this panel today. Once again, thank you for joining. It was really comprehensive. I think we got our answers, or at least our predictions to what is going to happen beyond 2020. So thank you for joining.
Awesome. Thank you for having us.
Thank you.
Thank you very much. Have a nice day.
Bye, everyone.
Bye.